It's an urgent alert. I'm your host, Steve Metre, and thanks for joining me today. At our lead story today, a major currency meltdown begins tomorrow. I'm going to show you how the outcome of the U.S. presidential election could send this currency crashing, and why its recent moves have wreaked havoc on the global economy, and how it could send the entire world into a recession. And we told you it wouldn't work. I'm going to show you why China's latest stimulus plans are going to send its housing market and its banks crashing. Plus, we have a sponsor for today's show. We'd like to welcome BioVax's Technology to the show. You can find them on the CSE under the symbol BIOV and on the OTCQB under the symbol BAVXF. And an investment in BioVax's is like acquiring a $300 million biotech portfolio for pennies on the dollar, with near-term revenue potential from licensing deals. And if you're a swing trader, you're going to love this setup, because we've shown you a few of these recently, and right now BioVax is in the middle of a swing, and we think one that could go another 45% higher. Stay tuned at the end of the show, or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: as a Trump trade doubts drag on the dollar, boosting U.S. Treasuries. And now the election is turning into a trade on the dollar, and we've been seeing the dollar on a tear recently as investors buy into the narrative that we're going to see a complete Republican sweep across the White House and Congress. And this has been sending the dollar higher, on the fact now that many are believing that the moment former President Trump retakes the White House, that he's going to enact policies which are going to send the dollar soaring, despite the fact that many people are racing into gold under the belief that we're going to see a massive devaluation of the dollar. We're going to show you why the dollar is likely to plunge now after the elections, why it could send the global economy into a recession, and more importantly, why it's wreaking havoc today on the global economy. And as we move closer to the U.S. election, there's less confidence now that Trump will win the election. So we're seeing now a change in the markets. A Trump win and red sweep would be the most bullish outcome for the dollar, while Harris win with a divided Congress could see the U.S. dollar quickly giving back last month's strong gains. And that's really an interesting question here, is why is the dollar rallying? Well, it has a lot to do with the fact that what we're seeing from former President Trump as he campaigns to take the White House perhaps for a second time, that his policies are actually deemed to be dollar bullish. But that may not be the entire reason why we've seen a recent rally in the dollar. And here we can see, starting back in late September, the dollar went on a tear, and the media and Wall Street have been saying it has everything to do with a potential red sweep, not just again of the presidency, but also both houses of Congress. And it starts to make sense of why you would see this, because when you start to curtail global trade, well, that's what the dollar's all about. Because what you see here is a liquidity issue in the dollar, where there's not as many dollars in the system. So those that need dollars, well, the price is now going up. Because when you think about how dollars are created in the global economy, it's through global trade. And when you put big tariffs on, well, the immediate outcome is going to be a reduction in trade, reduction in the creation of dollars at a time, and always a persistent issue where there's a global dollar shortage. What perhaps we're seeing here is a global dollar shortage is getting even worse, and that's causing major problems across the world. In recent weeks, investors have been betting on a Trump win, positioning for his low tax and high tariff policies to boost both growth and inflation. Those bets helped boost the dollar gains to a 4-month high last week and sent yields on 30-year treasuries to their highest level since July, creating a steeper yield curve. But meanwhile, emerging market investors have been bracing for the fallout of a potential Trump victory, as his plans to enact tariffs would weaken their exports and demand for their currencies, but it would cause, of course, the dollar to go up in value, because again, we need dollars because there's more debt and not enough money to pay on it. So what you need in the global economy, particularly as the reserve currency, is a constant creation of new money. Well, if you curtail global trade, next thing you know, there's still a demand for dollars. There's still too much debt, and there's not enough dollars to pay on it. That means dollar goes higher in a big way, and it could have a disastrous outcome for the global economy. And we can see a rising dollar is already impacting the global economy as we look to Chile, whose economic activity now plunges the most since 2022, an appalling report. And these are effects of a strong dollar, because in a global economy, when your currency is the reserve currency, as the dollar is, what you need to see is a perpetual long-term weakening of the currency. And that's just the effect of what happens through global trade, because again, in global trade, there's money borrowed, money created, and over time, you get a gradual weakness of the currency. The problem is when you see a sharp and big move in the dollar, well, it causes big problems, not just in Chile, but you're going to see in other parts of the world, even here at home. As mining activity plunged by 2.8% on the month, while industry declined 1.6% and services slipped 0.2%. And retail sales beat analyst forecasts by rising 3.9% in September from a year ago. But hang tight, I'm going to show you why that's not going to last, because on the other hand, both industrial production and manufacturing unexpectedly contracted during the period. And what we're seeing is a decline in demand. This is something we see here in the US as well. You can get rising retail sales, but if you start to see weakening industrial and factory production, it's a huge red flag for the economy. What's telling you is demand is weak, inventories are high, and just the fact that, of course, we saw retail sales rise in Chile doesn't mean anything. Let's take a look at the US data here, because we have advanced retail sales in blue against industrial production in red, both shown on a year-over-year rate of change. And you can see periods where right here, like in the late 1990s, where you see rising retail sales against a decline in industrial production. What that's telling you is there isn't enough demand for new orders because there's too much inventory. And next thing you know, the weakness in industrial production sent retail sales and the economy into a recession. We sort of see that repeat here in around 2008. You see retail sales rise against flattening industrial production. Next thing you know, they both turn down. How about around 2011? You see industrial production start to decline against rising retail sales. Again, it doesn't work out for the industrial complex. You see retail sales fall, just like we did here around 2015. And look at right now, you see retail sales that are showing positive against inflation that's negative, against industrial production that is effectively unchanged for a better part of a year and a half. And the risk for Chile, and the risk for other countries as well, is when you see your industrial production decline, as we see here still in red, against the unemployment rate shown in blue. What happens as industrial production declines? What do you see? That means hours worked are getting cut, jobs are getting cut, and next thing you know, people are hitting the unemployment line. And we see that very clearly here in the late 1980s, going into the 1990s recession. The unemployment rate rises. Again, you see it going into the dot-com bubble. Industrial production kind of flattens out and then starts to decline. Next thing you know, those workers are hitting the unemployment line as well. And of course, there's no job prospects for them. And then how about going into the global financial crisis? Industrial production slowed a bit. We see that caused the unemployment rate to bottom out. And the next thing you know, industrial production rolled over, and that sent the unemployment rate higher. We're seeing that trend right now as industrial production is flatlined here in the United States. Tariffs are not going to make that any better against rising unemployment rate. What we're going to see around the world, as demand goes down, you're going to see more workers head to the unemployment line. What we're seeing here is the early stages of a globally synchronized recession. But is the U.S. immune from this? Well, not at all. Take a look at this from today. As U.S. factory orders tumbled in September by 0.5% month over month, and that dragged the year-over-year rate of change down to minus 1.6%. So we're seeing a contraction in factory orders, and that means, of course, the unemployment rate is soon to head higher. Core orders, excluding transportation, rose 0.1% month over month. But check this out: durable goods orders, this is the final print, fell minus 0.7% month over month. That is horrible. How about orders placed with U.S. factories for business equipment? Well, that declined in the preliminary October data, and the prior month's gain was revised lower, suggesting firms are more guarded about investment. No, it's not about being guarded about investment. It's about the fact that demand is going down, and these companies do not want to invest into, of course, their factories and their production if they don't need to. This is a simple case. What we're seeing is a global economy get far worse and far quickly. A lot of it now has to do with the dollars we see in Chile. And markets are pricing in a higher chance of a Harris win now, and that means the scope for dollar strength is now higher in the event of a Trump win, because again, you talk about global trade. If we see Kamala Harris take the White House, well, they're not going to enact a bunch more tariffs on China. They're going to keep the global economy flowing in terms of a trade perspective. That means we're likely to see the dollar weaken after the election. And part of what we're seeing is just a reversal of the price action that we had on Friday. It's not only the U.S. election, there's so many other things going on this week. And that is a really good question here. Is it about what's happening this week with the dollar, or is this simply looking at an election trade? Because I think it's something worse. We've seen a slowdown in the global economy. We're seeing a slowdown in trade. That means fewer dollars are created at a time when we still have massive amounts of global dollar debt. So you have too much debt and not enough currency to pay it. Those who need dollars are now being forced to pay more. That's why we're seeing the dollar rise here. Will we see it sell off after the election? That's the question. If we don't, well, it tells us we're about to enter a massive liquidity crisis all over the world, and has everything to do with the dollar. And let's head over to China now, where I said this wouldn't work as Country Garden sales slump abates after China property stimulus. Again, we told you the stimulus wouldn't work, and there's a very simple reason why. It's because China is the world's largest exporter. They don't have enough internal demand. Now, they have enough people, they just don't have enough internal demand to drive their economy. It's all stemmed from the rest of the world. And as we see demand fall through other parts of Asia, Europe, the United Kingdom, and the United States, through North America, what this tells us is China is in trouble. This is exactly what we're seeing here. So they tried to stimulate their economy to get the housing market to turn around. We said it wouldn't work, and sure enough, check this out. In September, China began introducing a series of measures to jumpstart the economy and property sector, including cutting borrowing costs and relaxing buying curbs in big cities and down payment requirements. Improving sales at the distressed company, once China's largest builder by contracted sales, may temporarily soothe investor concerns over its liquidity, given it's counting on more transactions to fight off liquidation. And so this is a problem. They're chasing this thing, and it's not good. They need to sell more homes to keep out of a liquidity crisis. It's dangerous because if they don't hit their numbers, and as you're about to see, they're not. Well, what it means, of course, is another builder is about to default on more loans. That's going to send their banking industry into a liquidity crisis, and that too is going to flow all over the world. And if you think a stronger dollar is going to make it better, absolutely not. It's going to make it worse. A creditor filed a petition against Country Garden in February after the builder defaulted on dollar debt a year ago. The company is in talks with creditors for a debt overhaul, but it's already missed a self-imposed target date for getting key creditor support for terms of its restructuring plans because, of course, creditors are realizing they can't turn this around. It's a dangerous problem in China. Their economy is getting worse. The U.S. economy is starting to get worse, and the dollar is making matters worse for all countries all around the world. The only issue is, was this a trade about the election on the dollar, or is it a sign of an impending liquidity crisis, all centered around a rising dollar? Well, we'll find out soon enough. But for China, we're going to find out on Friday as they gear up for a big week as markets await the U.S. elections and stimulus details. And this is one all about timing, because many believe, depending on who takes the White House tomorrow, well, that'll have a big impact on what China's about to announce. Because investors expect Beijing to announce details on final fiscal support on Friday. And that's when the Standing Committee of the National People's Congress, China's parliament, is due to wrap up a 5-day meeting. The same gathering last year oversaw a rare increase in fiscal deficit. This year, we know they're aware their economy is headed into recession. The dollar is screaming higher. They could be in for a surprise based on the outcome of the U.S. presidential election. But no matter what happens, what we're seeing in the dollar, what we're seeing in factory orders and industrial production is all telling us that the global economy is headed into recession. And the only thing that can change right now that could help is the dollar to weaken. We'll find out tomorrow if it comes crashing down based on how, of course, the election turns out. We'll find out more. But something we think is going to soar higher, that's the stock for our sponsor for today's show, BioVax's Technology. You can find them on the CSE under symbol BIOV and on the OTCQB under symbol BAVXF. All the information in the pinned comment and description below, because they're revolutionizing immunotherapy. therapy. And Biovaxis is a clinical stage biopharmaceutical company dedicated to improving patients' lives with novel immunotherapies based on its DPX immune educating technology platform and its Haptenix nanoantigen tumor cell construct platform for treating cancers, infection disease, and antigen desensitization, peanut allergy, and other immunological conditions. The recent acquisition of all IMV Inc. intellectual property and development assets now gives Biovaxis Technology a portfolio of 120 patents and patent applications developed over 25 plus years, including discovery, preclinical, and clinical development stage assets in oncology, infectious disease, and other immunological fields. The acquisition allows for the integration of IMV's DPX immune educating platform in clinical development programs with Biovaxis' legacy Haptenix nanoantigen platform and clinical stage ovarian cancer program. And it's significantly undervalued. As we started the show, this is like acquiring a 300 million biotech portfolio for pennies on the dollar because they have some near-term revenue potential opportunities through licensing deals, as they are significantly undervalued relative to its peers. And we talk about the investment opportunity in Biovaxis. They're significantly undervalued. They have robust science, a highly differentiated delivery platform, broad licensing opportunities, and BD-focused leadership. Now, listen back at a press release from earlier this year as Biovaxis acquires all intellectual property, immunotherapies platform technology, and clinical stage assets from the former IMV Inc. And we can go back to look at IMV because Raymond James, well, they put a big price target on them, and that helped send their stock soaring. So we could see the same with Biovaxis now that they've got all their patents. As Biovaxis DPX exhibits superior immune system activation compared to aqueous and emulsion-based antigen delivery systems. And Novo Nordisk has continued to push its into genetic medicines, agreeing to pay Nanovation Therapeutics up to $600 million to collaborate on up to 7 programs built on technology for targeting cells outside the liver. And under the terms of the deal, Genevant has given Repair non-exclusive worldwide license to some of his lipid nanoparticle technology so that Repair can create cholesterol-degrading treatments. Genevant can net up to $107 million in upfront and contingent milestone payments for each product developed using the technology, and could also receive tiered royalties on future product sales. And this is the same situation we see Biovaxis in now that they've acquired all of that intellectual property from IMV. But let's talk about some other things Biovaxis is up to, as Sprayvac for Wildlife announces completion of a Sprayvac research and production facility in Madison, Wisconsin. And Sprayvac uses patented liposome-based antigen delivery platform technology, which has generated a robust and sustained immune response in several species. Sprayvac's single-dose vaccines will address the fertility control needs in wildlife, agricultural production animals, and aquaculture markets. And Biovaxis DPX-based vaccines exhibit robust efficacy across multiple infectious diseases. And here you can see that Biovaxis DPX technology is a patent delivery platform that can incorporate a range of bioactive molecules to produce targeted, long-lasting immune responses enabled by various formulated components. The DPX platform facilitates antigen delivery to regional lymph nodes, has been demonstrated to induce robust and durable T-cell and B-cell responses in preclinical and clinical studies for both cancer and infectious diseases. But let's talk about that chart setup. We started the show out, that swing trade that we see could generate another 45% move. Here we've got the 9-day moving average, that in gold, against the 21-day exponential moving average, that in green. Here you can see right here that candlestick closed over the 9-day. Well, that initiated the swing trade, and you can see a stock moved up. It's run into a little resistance here right around 6 cents a share, but we believe that the swing trade is still in force because it's holding against this 21-day exponential moving average, and a breakout above 6 cents could send Biovaxis up to 8 cents from where it's trading today, would generate a potential 45% return. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.